This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Emil van Essen. He's a trader. He runs a managed futures firm. Has been at this game since the late 1990s, trading for clients. His original trading experience goes back to the mid-1980s. Emil is not a trend-following trader. He is a spread trader. While he may bring a different trading perspective than what is normally seen in my world, definitely insights for everyone in this episode. I hope you enjoy this conversation with Emil van Essen. So I was thinking to the first time I heard your name, and it was actually from one of the famed turtles from Richard Dennis's group. And I remember Lucy Wyatt was telling me about you. She's like, "You got to meet this guy, Emil." This is probably, I don't know how many years ago, a long time ago, but today we finally get a chance.
5 years ago, anyway.
Yeah, we finally get a chance to meet today after her telling me all these years ago that we had to connect. This is long before I had a podcast. She was telling me about you.
But you already had your book then, right?
Yeah, the book was, oh my gosh, 10 years ago. Wow.
Right.
Time flies, huh? Super flies.
Yeah.
Well, listen, here's where I want to jump in today. I want to go back and touch on some of your background. I'm going to go into that in a second and kind of how you got started. But I think out of the gate, because our episode and what we're going to talk about today is very different than what I typically talk about on my show. Even though I've had traders on with very different strategies than trend following, I've definitely have not had a trader on that employs your particular strategy. And I think it'd be great out of the gate if you put your professor hat on a little bit and actually just talk about spread trading and define your style of trading to the audience. Some people have heard of it, but very few people have ever really traded as a spread trader.
So, yeah, we trade spreads, which is the difference between two contract months. Or, that's calendar spreads, or the difference between two related products. So we would call that a relative value spread. So some people might do a ratio between gold and silver, or in the energies, they might do what's called a crack spread, which is, the difference between crude oil and the products that you refine crude oil into. So the crack spread is a profit margin. So these are all the, we would call relative value spreads. Something becomes mispriced compared to a closely related product, and, we think it's going to change. Calendar spreads is really just the relationship between the same product at different points in time. Just to give an extreme example, gasoline, which is much easier to make in the winter than in the summer because the government puts all these restrictions on volatile substances that can't be in summer gasoline. And so it's much costlier to make summer gasoline. So the spread, what we would call between, let's say, March and April, is really the spread between two different ways of refining gasoline. That's a calendar spread.
I mean, in a nutshell, for example, buying September corn futures and selling December corn futures. I mean, it's looking for, I guess one way for the audience to think about this is it's an arbitrage type thinking. You're looking for that disparity. You're looking for that element that's been mispriced. You're looking for that opportunity.
Yeah. So September, December corn is a classic, what we would call old crop, new crop. September corn is the current crop. December corn is the new crop. So between September and December, they bring in all the corn, and that's the new crop. So let's say you are expecting a bumper crop. Let's say you think, the crop is going to come in great. We're going to have so much corn, we won't know what to do with it all. Well, then what's going to happen? If there's a shortage of corn now, then the front month corn may be higher. You get a lot of things going on with things like shortages or big price moves where the front month will tend to go up much faster than the back months. Or in in crude oil, for example, there's all kinds of guesses when crude oil collapsed as to all the rigs will, stop drilling for oil, and then all the Bakken, shale is going to start running out, and then all of a sudden we're going to have a bit of a shortage again in another year. So people can start playing, how do I, if I have a view on the difference between two different periods of time, 2 different months, how do I trade that? And we would like to say that it's much more involved than trend trading. So we would say in trend trading, it's sort of one-dimensional. You are either betting that the market is going to go up, down, or stay the same. Crude oil, wheat, whatever, anything. But in spread trading, you actually have a multi-dimensional surface where you're saying, I'm not only predicting whether it's going to go up or down, I'm looking at all the months, and I'm seeing which one's going to go up the most relative to all the others. So there's the number of combinations you can play is huge. So it gets much more complicated and more interesting for me because you can pick and choose exactly the opportunities you like the best. The other thing that everybody's used to trend trading, which means, if the market goes up, it's likely to keep going up. And if the market goes down, it's likely to keep going down. So the premise behind trend trading. In spread trading, it's completely different. The spreads tend to not trend. They tend to mean revert. If you try to play it trend, you'll tend to lose money. So you can't just fall back on the trend. You have to have models to figure out what's going to happen, relatively speaking. But if you just play mean reversion, the opposite of trend, you're probably going to lose money too, because occasionally something massive happens. Like right now we're seeing in gasoline, there's a shortage of gasoline and the front months are skyrocketing. And if you'd played mean reversion, you'd probably get killed too. It's a fine balance. And we kind of think with all the craziness, there's a lot more money to be made in spread trading, but you have to be diversified.
As you lay that out and you talk about the possibilities and the different combinations, you're talking across mostly commodity markets, if not all. We're talking energy, physical, metals, ags, grains, right?
Correct.
That's your
and
softs. So that's your world in there. Now, when you were just describing, and we're going to get into some of the strategic ideas here, but you are, even though you were kind of making multiple fundamental examples or scenarios, but you're about 80% systematic. Is that a fair assessment?
Well, it's hard to put a number on it, but I would say at the base of every trade is a model. So we use a lot of models, and that would be, I don't know if I would refer to it as systematic, more as model driven. Like trend guys say systematic, because it's just, the trade just goes through. But we basically have a bunch of models. The models generate trades. Then we try to understand the fundamentals to see what's going to blow up in our face. And we try to factor that in. And in other words, like, let's say your models say something's going to happen and you've done testing on the last 20 years. Well, let's say something's happening fundamentally, like the drought in 2012 that hasn't happened in 50 years. Well, you might be dealing with a situation that never happened in your data, and you need to know that. Otherwise, you're going to get in trouble.
But it's tricky, though, as you bring up some of the comparisons to trend following. It's tricky because as you talk about the possibilities in your world are a tremendous number of possibilities. And then when you add in all these different commodity markets, the fundamental understanding requires a great deal of depth. So I guess when you're talking about the models, those models, though, are doing, you have figured out the model for these particular strategies on these particular markets, and you're saying there's a discretionary fundamental component kind of on the back end, and the model is what you've thought through at the front end is doing the brunt of it. I mean, the model itself.
The model gets essentially the probabilities on our side, and we don't try to use fundamentals to predict. I think that would be a dangerous game. What, I'm going to predict gasoline demand better than BP and Shell? I don't think so. So I think I'm at a big disadvantage. Am I going to know the bean crop better than Cargill? Or it's just not a good idea for me to try to do that. What I try to do is assess the probabilities based on historical testing, and then understand kind of what's going on fundamentally, but not necessarily trying to predict it. One of the other reasons I like to know the fundamentals is I think I have a very strong view on how fundamentalists trade the market. So I think there tends to be a fundamental theme, let's say, that's going on, and that theme starts building steam, and all the fundamentals get on that same theme. And I think the market gets overdone. And so you want to know what that theme is and what's going on and when it's sort of saturated the market, and then it's probably going to come back the other way. So that's when the fundamentalists lose money, because when the price has already moved, they still see the same fundamentals. They don't see that the price has already made the move that reflected their fundamentals, and they don't realize it's going to come crashing back down on them. So I try to have a trader's mentality when it comes to understanding that.
I think one of the cool things in your world, at least I'm sure there's multiple sources, but I thought the growth of commodity ETFs and how part of your strategy is, I guess one way to say it is taking advantage of this growth of commodity ETFs and how they have to go through their day-to-day machinations. Their strategies leaves the door open for other people to have strategies to take advantage of. Why don't you talk about that notion of your particular world and the growth of commodity ETFs and what you have discovered?
That used to be the roll arb trade, which we did for years, and that's how we started, more or less. So roll arb is when, and it's not just the ETFs, it's anybody, generally speaking, long-only funds. So, whether it be Goldman Sachs Commodity Index, whether it be pension funds who are replicating these indexes, and they're long a basket of commodities. Essentially, when they got really big between 2001 and 2007 and 8, they increased in size just by a huge amount. So they were hundreds of billions of dollars. They were all rolling at the exact same time, which means they're long the front month. Let's say right now it might be August, and they have to sell August and buy September. And that's the spread. When they sell August and buy September, they're selling the spread. We always say when you sell the front month and buy the next month, you're selling the spread. So they have to sell the spread so that we know they're going to knock the prices down. We sell ahead of them. We front run them. So this has been a normal thing. Now, everybody's front running these guys now. The long only funds have gotten smarter over the years, so they do a lot of things to protect themselves. So that trade has kind of gone away. There's other trades like front running the trend followers, which I think is a better trade. So when all the trend followers, they can't really split their exposure over 12 months. So they can't go out the curve and put a little bit in every single contract, because they have to be able to flip their position when the trend changes. So they kind of have to be in liquid contracts. But when the time comes, they have to be able to switch their position. So we try to kind of track the trend followers. We know what position they're in, and we know when they're going to roll, and we tend to get in front of that roll. So it tends to be a good trade. Even if you're not right all the time, you kind of know that the market's going to have a strong bias. So we know, for example, if a market's going up and up and up, and we know all the trenders are in, and we know the open interest is starting to turn down, well, we know what's going to happen. I mean, they're going to have to roll out of their position.
As you brought something up, I would love for you to go philosophical for a moment, because I think we've seen in the last, I guess probably going back at least 10 years, this advent of long-only commodities. and I'm not even talking about your strategy right now. I just really would love for you to kind of go philosophical. It seems like it's a really odd thing that we convince so many pensions and institutional investors that they should be just long only commodities. Like somehow or another, commodities would only go up. It's a really bizarre sales pitch that got sold and bought into, isn't it?
Well, I understand what they're thinking, and I'll give you my view on it. Essentially, the goal of a pension fund or all these guys is to raise risk-adjusted returns, and generally you do that through diversification. But over the years, equities and bonds have become more and more correlated. You can't, no matter what kind of portfolio stocks you have, you end up essentially being an index. And then even if you go internationally, all the indexes are getting more and more correlated. So over years, there's just this huge correlation. So there's no diversification. So they said, well, what is something that we can get into that's relatively liquid and that's not correlated? Boom, commodities. Okay, so this was the theory. The theory was that when stocks get hammered and bonds get hammered, commodities will do well. It's a diversifying tool. I understand. So that's the theory behind it, and it makes some sense that when you run the numbers and you add commodities, you don't hurt your returns, but you help your risk. I always say that long-only commodities or passive long-only is like the gateway drug into commodities. People don't understand commodities. They get sold on this diversification idea. They come in and they say, okay, let's put billions of dollars on long-only commodities. Then like a year later, they're like, hey, we see all the non-correlated tremendous volatility. Do we get any return with this volatility? It's like, oh, you want return? You didn't say that. Now, if you want return, that's a little bit different. So then they got to say, oh, well, for that you need active long only, right? So people go, oh, okay, we'll actively manage the long only. Then we need a manager. Then we need to pay fees. And then at some point somebody goes, well, why do you need to be long only? I mean, what you're looking for is something non-correlated, but why does it have to be long only? What's the point of that? Why do you somehow have a crystal ball that tells you that commodities are only going to go up? Why not play it both ways? Isn't the idea just to diversify? So then people go, oh, actively manage long short, and lo and behold, they have a CTA. So that tends to be the evolution of thinking of managers over time. But then they started doing that, and then commodities got under fire in the last couple of years, and so now everybody dropped commodities, but I'm sure it's going to come back because actively managed commodities is probably a pretty good investment for a lot of these guys.
Hey, talk about diversification, and let's talk about your unique diversification. Where do you come, if you were to describe the playing field, which you've been doing, talking about other styles and your style, where do you fit when it comes to the zigging and the zagging and correlation?
Well, one thing our investors really like about us is we're probably one of the only CTAs that's negatively correlated to trend followers, and for good reason. As I said earlier, spread trading is more mean reverting than it is trending. So you tend to, let's say if a market's shooting up, a commodity market, the spreads will tend to get a little out of whack and then they revert back. So we tend to be selling into those moves. The same moves that the trend guys are buying the outright, we're selling the spread. Now we might hedge it or do whatever. If the market chops, it tends to work to our advantage and against the trend guys. So we tend to make money at opposite times. So we tend to be a great diversifier for a trend follower naturally, because when we get hurt is when a market just goes up and never stops. And that's what helps the trend follower. But when a market spikes up and then comes back down, we make a lot of money and the trend followers lose a lot.
I'm curious. I was looking at your performance, 07, 08, 09, 2010, 2011, really, really gangbusters performance. 12, 13, and 14, 2012, 13, and 14. you didn't lose a lot, but it was just kind of down. It seems like a noticeable like 5-year gangbuster window and then kind of a 3-year slightly down window. How would you describe what you've seen over that 8-year period and maybe perhaps the performance difference? Because look, when I look at trend following, I kind of instinctively know after all these years what's going on behind those ebbs and flows. But since I'm not a spread trader, I don't know all about your strategy. I'm curious how you view the performance.
Well, some of that was that there was certain aspects of spread trading that didn't work for a while. There's certain tendencies in markets that just, stop or temporarily stop. So that's one thing. But there was another thing that was sort of unique to us. And maybe you call it a mistake, or, it's a mistake, but nobody's got perfect, forward vision. But essentially, we got big, and when we got big, we took in institutional money, and the institutional money wanted more risk controls on drawdowns and things like that. Now, if you look at the great spread traders, like, let's say John Arnold trading natural gas, these guys had drawdowns. They had big drawdowns and they stuck to their positions and they made money. So we initiated some of these risk controls in early 2012. And we were big. We were getting bigger and bigger. And what happened is the drought of 2012 happened. We got caught in a market where essentially a spread blew up. Somebody got caught on the wrong side. It was in the middle of the drought. There was no liquidity. Somebody in Asia pressed the eject button on their position, and because there's no liquidity, some spread went to a multiple of anything that had happened in history. All of a sudden, it triggers our risk controls. And we were forced to bail out on a trade that we knew was going to make money. But we had to follow our risk controls. So we bailed out of this trade with a big, big loss. The trade came all the way back, we would have ended up making money. So if we didn't have those risk controls on, or if we would have had a little laxer risk controls, it jammed us out of the market at the worst possible time. And that cost us a lot. And then it happened again and these were there was basically 2 trades. 1 in 12 with the beans, and then 1 in 13 with crude oil. Again, it triggered our risk. Again, we had to bail out, and again, the market came all the way back down. So guys like John Arnold, they were successful because when they knew that trade was good, they stayed with it, and their investors stayed with it. And probably up to 2012, the investors we had were really solid and were with us, and they would actually add on drawdowns. We had, in 2013, we made some changes, and I think things got a little better, even though we had a little bit of a loss. And then now, I think we're up pretty good this year, and I think things are back to normal. So what we said is maybe there's some increased volatility in the spread market, so we're going to maybe lower our position sizing a little bit, but we're not going to just bail out because some computer says this is the point at which you got to bail out. We're going to be sensible. Isn't
it funny that you can sit here with me and you could give this example that everyone listening will understand? If they're not familiar with Arnold, they can quickly figure out his background, tremendously successful. But here you just map out this case and you really say that, Arnold, believing in his strategy, you guys believe in your strategy too, but perhaps his investors understood deep in their gut more what was going on, whereas you couldn't really even sit there with that particular group of investors and say to them, hey, let's think big picture here, because they had the MBAs in a boardroom somewhere that had figured out that this is all we're willing to take. And even though they had invested in the strategy, invested in you, believe in it to make the allocation, they get overridden by something that, look, cutting your losses is part of the game. I get it. But if you're going to go ahead and do the homework and make an allocation to a spread trader, it sure seems like you should have a little bit of stick-to-itiveness.
Well, I would say this, that these guys, the guys who were, behind pushing this, are smart guys. I think they had the best of intentions, But I don't think they'd have gone into so much, and they tried hard to understand the program. And the people who were looking at it were very smart people. But to understand the nuances of, hey, spread trading is a really different animal. Like, if you're trend trading, like, you're always capturing that extreme volatility. Whereas if you're spread trading, you're sometimes the victim of that volatility. And you have to, and if you're not well diversified, you have a problem. John Arnold was not diversified, but he was a good trader, he had good positions, and his people stuck with him. And I had that kind of investor base prior to 12. And it was very helpful for making me money. And I would say that if John Arnold had a institutional kind of investor base when he was managing, he might not have anywhere close to the returns that he had.
Yeah. I think you make a great point. You know, for those in the audience that are listening to, perhaps they're interested in your firm, perhaps they're just interested in learning about trading, but I know there's plenty of people in my audience that are interested in learning about the job description of managing money. And you are laying out quite clearly that, you know, look, you might have a strategy. You might be very good at what you're doing. And you might get people knocking on your door saying, I'm going to give you XYZ millions of dollars. But that money might look great, but not all investors are created equal. And you're really painting a nice picture of that.
Yeah, and I would say something else, whether you're a trend follower or a spread trader or anything. You know, trend guys like to say, hey, we're 100% systematic, we're totally regimented, we just follow the rules, blah, blah, blah. I think that's a huge mistake. I mean, I think we've got these brains, and these brains are way more powerful than your computers, and things change, and you have to adapt to change. And you have to be smart enough to know, hey, don't be emotional about following my trades, but be very vigilant in understanding the winds of change, because if you don't adapt to change, then you're not going to last. And trend guys who don't adapt, I think they won't last either.
It's an interesting discussion, because I can think of a lot of names, and you know the same names that have been around for a long time. And some of them have stuck to their guns and done very well. But I think usually the guys that stick to their guns, if we're talking just about the idea of getting clients or keeping clients, the guys that stick to their guns, they often make a lot of money, but they have drawdowns that the institutional world just won't pay attention to. Whereas the trend following traders that have said, we really want to appeal to the institutional money, have created a product that looks friendlier. So, I mean, I think you could see that change and that adaptation when you create those products that look friendlier.
Yeah. So, I just think you got to keep your mind open. Like, for example, we were doing roll art for a number of years, but the environment actually changed. It really changed. I mean, we would talk to the big players who were handling long-only money, and they were telling us they were changing their roll strategy. So if you didn't realize that this was happening, and I would monitor what was happening during the rolls, and all of a sudden I started seeing some bizarre behavior during the rolls, which told me that things had changed a lot. And we all of a sudden started backing off. I think there was a lot of people who were very quant, only quant. They weren't real traders. They just kept doing the same thing, and they went out of business.
You've been a CTA since 1997?
That's correct, yeah. And
your trading experience starts, when do you date your first kind of real trading experience?
I would say 86.
86.
Well, no, actually 86 is when I started professionally. My first trading experience happened when I was 12 or 13. I had a paper route. I delivered papers, and I would take the money and I would buy rare coins. And the guy there was a new shopping mall near my house, and I would go there and buy rare coins. I don't know why I was like an investment minded then, but the guy was a commodity trader who owned this store. And so I would start asking him all kinds of questions about trading commodities. And he would tell me about selling short and, crops and all this. And I started trading parts of his contracts. He would let me trade, put up $100 to trade a part of a potato contract. And so I started reading. By the time I went to high school, I was reading all kinds of books. By the time I was 16, I got registered in Canada as I wrote the license to be a broker when I was 16, and then I went to some brokerage firms, and they go, "You're 16, please go to school," you know?
Hold on. You were showing up. You were showing up at commodity brokerage firms looking to work or just trade at 16.
No, looking to work. I wanted to get it. I loved it. I thought this was my dream job. So I actually got. I went to University of Waterloo for math. I got a partial scholarship. I went to Waterloo for math, and then I got a job at Prudential Beige Securities, a big brokerage house known for commodities, when I was 21, and that was 1986 when I got that job. Right away, I opened a personal account and traded my own account.
How quickly did you start to become aware of? I mean, the CTA space was. I mean, there were some big players at that point in time, but it was still in its infancy. It was not kind of a well. I mean, I've gone back and looked at all the writing. There wasn't a terrible amount of writing everywhere. I mean, there was guys like Paul Tudor Jones and Louis Bacon that were starting to make a name for themselves. But how in tune were you with the notion of people running funds in the commodity space in the mid to late 80s at that point in time in your career?
I was not, but I was aware of trend trading, and data was starting to become available. And I remember the program System Writer Plus was out there. So I spent all my hard-earned money back when I was in my early 20s buying data, testing things. I think, like, I talk to our research guys now, and I'm like, you know, I would write like 20 different strategies in a night after work, right? I would sit there and code all these strategies. I mean, I was crazy about it.
System Writer, for those that don't know, would be the precursor to TradeStation.
Right, and it was a great product too, and really allowed you to test a lot of things. I started buying like tick-by-tick data and testing that. It was kind of ridiculous, but I just remember how slow the computer was, and I would have a dot matrix printer printing out the trades back in like 87, and it would print all night long, and my girlfriend was like, "I am never going to stay here again."
Did you have any mentors at this time? I mean, or was there at a point in time, even a few years ahead, where you had a mentor or someone in the industry that really struck you even beyond the first story you just mentioned?
No, not really. I mean, there are people that were older than me and more experienced, but I think the idea of like computerized trading or testing was sort of in its infancy then. Now, probably maybe in the early 90s, there was, I built a bond program, and somebody saw it and called me up, and they said, "Hey, you should become a CTA." I was like, "Oh, well." He goes, "I have Richard Dennis, I have Paul Tudor Jones, right? I have all these guys," and he says, "They do really well." And he faxed me over a check for an incentive fee that he had just sent to Richard Dennis for like 200 and something thousand. And he says, "Look, this is going to be you one of these days," right? And he says, "You got to get registered, and I'll give you some money to trade." He did that. That's kind of how I got started as a CTA.
That's straightforward. The investor actually kind of showing up and saying, "Hey, I like what you've developed here. I want to stake you. Go."
Yeah, and he would tell me stories about, he said the first 25,000 I put with Paul Tudor Jones went to like 2.5 million, stuff like that. And I love trading. I just for me, it's not work. It's just a pleasure, and it's always been like that. And I'm just still, my eyes glaze over at just the marvel of just being able to trade the markets and make money and find ways of predicting what's going to happen. I think it's amazing.
Talk about that word though for a second. It's one of those buzzwords, and I find generally though, every time I want to pick on the word prediction, I find that when I dive deeper with somebody that uses it, we're often saying the same thing, but it's one of those terribly misunderstood, and different people will use it in different contexts. Talk about what you mean when you say prediction in the context of your systems today. You're really talking about the probabilities, aren't you?
Yeah, and it's funny because some people think prediction means you're certain you're 100%. And I'm just one of these people. I think in terms of probability. Everything I do, my brain just works that way. So when you read a book and the guy says like the Zen of trading or whatever, hey, you got to think like in terms of probability. I'm like, well, that's how I've always thought. So when I talk about prediction, I just mean you find some method that reliably tells you that something is going to happen more often than not. So there's some tendency of the market to do something over a large number of trials that's consistent.
An edge. You try to find your edge.
Yeah, that's what it is. It's all about edge. And edge can just mean for a trend follower that they think that for reasons I understand, that the markets will blow up more than they'll consolidate. So that's an edge. Or you might think, hey, guys have to roll, and if I get in front of that roll, sometimes it'll work, sometimes it won't. But if I do it 100 times, it's going to work. It's very likely to work, or whatever. So this is all we're doing. We're trying to find consistent behavior patterns that occur, that give you a risk-adjusted return, or the probability of something happening is more than the probability of it not happening.
Yeah, I mean that really sums up good trading, regardless of strategy chosen. I mean, those foundational elements are going to be in every style of trading, and then what you pick ultimately to try and get your bit of alpha, that might differentiate, but that foundational stuff is going to be, it's not going to change.
If all you're doing is beta, and I kind of think of trend following as beta.
Yes, I saw you say that comment. I'm sure you realize that plenty of my guests and maybe even me would go ahead and say, well, hold on. But the floor is yours.
Well, let's say the second, like beta is, let's say, an asset class, the movement of price in an asset class. So let's take maybe the second derivative of beta. So it's sort of a group that's doing the exact something very similar in an asset class, and then that becomes a sort of second derivative beta. So then within that group of trend followers, you have people that create alpha above the normal trend following. So let's say you say, I'm going to use a 200-day moving average as my standard benchmark for beta, and then if somebody has built a better mousetrap, then they're creating alpha over that. So that's all I'm saying. If you take something very simplistic for trend following, then the ability to outperform that as a trend follower is creating alpha. So it's sort of like when a drug company creates a pill. Well, we know that taking a pill has a placebo effect. So when they compare the efficacy of a pill, they got to compare it to taking a sugar pill, not to doing nothing. Because your body, when it takes anything, thinks, okay, it's healing itself, and it does it itself. So I would say, there's alpha, and alpha generation is just creating strategies that work more than they don't work.
I think one of the issues that you brought up today, though, and I'll kind of wind us down, but one of the issues that you brought up, I think, that is so critical for those out there, and a conversation like we're having today could be useful to different audiences for different purposes. To me, I always look at it, as we start to talk about something like alpha, I look at the notion of having a strategy to appeal to the most risk-averse investors. Perhaps they're not even that in tune with the best understanding of risk. I mean, someone walks in the door and they, for example, to a trend shop, and they only want to talk about the Sharpe ratio. But I see the issue constantly of raising money versus making money. And it seems like in my world, this trend world, it seems like a lot of the traders, I say a lot, but there's a significant number of traders that have not raised the most massive assets, but they have kind of stuck to their guns a la Arnold and have made a lot of money. And so it's an interesting trade-off today, and people have to kind of pick and choose what they want out of life. I mean, you can make a lot of money either way. It's just very different animals. And it seems like everything today comes down to client choice, or so much of it at least.
Well, yeah. I mean, you got to be worried about big hot money, because like if you're all of a sudden forced to reduce your position sizes unexpectedly, I mean, there's going to be big slippage there. But when you come to like, a customer is just, an investor's just got to realize, I mean, there's two issues. There's one, what's the risk-adjusted return of the person you're investing in? And number two is, what's his correlation to the circle you're investing in? So a guy can have a little bit less of a risk-adjusted return, but be uncorrelated. So when you add them with something else, the combination has a very high risk-adjusted return. I think those are the only two considerations. Make sure the guy is smart enough to make you money and honest enough not to cheat you, right? Those are, I mean, at the grassroots, at the base level, it's not that complicated.
And if you would like to find out more information about Emil van Essen, please go to emilvanessen.com. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.